Price to earnings, and this is pretty simple. It's just pulled directly off of the income statement tab. You see there? And it's green because it's coming off another sheet. And this is just the annual year-over-year growth. Now, remember, we're assuming because revenue growth is decelerating, LinkedIn wants to make certain shareholders happy, right? Because they're going to be losing some shareholders here. Some growth investors might, jump off ship here. They might not want to invest anymore because growth is slowing. And so some of the more GARPy investors, right, are happy to see, hey, check this out. You got yearly growth. Earnings growth is accelerating. That's pretty cool. Okay, so how do you come up with the right valuation for a company on a PE basis? Well, remember before I mentioned the PEG ratio, right? So if we assume that a company trades in line with its growth rate, right, which is what the market usually does over time, right? The market usually trades at about roughly 15 times earnings because the market's growing at 15%. And so if a company is growing at 30% earnings, it should trade at 30 times. That's actually a good rule of thumb. In fact, if a company misses earnings by 50%, then usually the stock goes down close to 50%, right? It's a 1-to-1 ratio. Usually, there are exceptions. And so here what we do is this market cap, right? You basically take the price this year, price target, right? You take $9.64 and you multiply it by 30 times or 30% times 100, okay? And that's a PEG of 1. It's growing 30%. Here, 29 times. Here, 27 times. Get it? Then up here in the bullish scenario, sometimes you get this in bull markets where companies trade at 2 times their earnings growth rate. Gets out of hand, but it happens. So here, 2 times our earnings growth rate, so 60 times earnings, which is too high, will get you that target price. And then the just right camp is in between 1 and 2, which is 1.5 times earnings growth. And so in this year here, we see that 1.5 times earnings growth times our EPS gets a target price of $4.34. Let's discount this guy down to today's terms like we did over here. And basically that means we take this, divide it by 1 plus the WACC to the power of 4, and that is our just right price earnings target price.